I'm speaking today to Angus Bell, Senior Portfolio Manager with Goldman Sachs Asset Management's Emerging Markets Debt Team. How would you characterize your approach to fixed income management as a house?
So yeah, we're particularly pleased, obviously, about winning such an award at an overall firm level, and I think it's reflective of our offering to clients that really covers the entire landscape across all of the different segments of fixed income investing. And this, I think, speaks to both the breadth and the depth that GSAM as a large fixed income house offers. If we think about the broader asset class, it's one that has benefited from that global breadth. And for the individual teams that are constructing portfolios in each of the particular segments, the idea of taking a team-based collaborative approach is really essential to understanding what's happening both in those specific markets, but also the concept of factors or information that might be occurring in one market could also be relevant for others. And so, the idea of collaborating and sharing what is taking place, I think, is particularly beneficial if we think about the individual teams. And of course, bringing all that together when we're thinking about our broader fixed income offerings, the idea about having all of that access to the insights and the information that these individual specialist teams are taking and bringing them together in some of our broader fixed income portfolios, and then designing those portfolios with the appropriate balance and resilience, I think has really been key. And this is, I think, what are some of the key offerings that we bring to bear as a large fixed income manager.
Over this period, then, what's been the biggest drivers of returns?
So over the last 12 months, or certainly through 2020, the biggest driver, or the primary driver of returns in the portfolio that saw us outperform the benchmark so significantly was really the decision that we made very early on in the crisis to essentially reposition the portfolio towards countries that we deem to be resilient to those uncertainties. And that essentially meant adding exposure in the portfolio to longer duration issues from sovereigns and corporates that had effectively a higher credit rating quality. So countries such as Indonesia, for example, Colombia, Paraguay, all presented opportunities from a valuation perspective against a backdrop where we thought their economies were likely to be resilient. The other key move that we made from a tactical perspective was to seek to capture opportunities in the local interest rate market for certain emerging market countries. And this was against the backdrop, of course, where many of the central banks across emerging markets last year were forced to ease monetary policy considerably in response to the considerable shock that their economies were facing under the COVID environment. And so that meant that many central banks around the EM complex aggressively lowered interest rates. And so we had positions in both South Africa and Brazil, which were two examples of countries that had relatively high real yields as we entered this COVID period, and their central banks had significant firepower to essentially ease policy rates. And so those off-benchmark positions that we had in the portfolio contributed very significantly to total returns.
How do ESG concerns filter into your investment process?
When it comes to assessing risks specific to emerging markets, a crucial aspect that has really separated them from developed markets through time has really been this heightened focus on differences in governance aspects, the related quality of institutions, and also the levels of social cohesion. So it's interesting for us that the assessment of these types of issues are being put in this category from an ESG perspective, but it's really crucial that our investors understand that this has really been a part of our process that's been essential and necessary right from the time that we started. What's certainly continued to develop against that backdrop of that momentum that the industry is seeing, which is really being led by the demands of our underlying investors, importantly, is to increase, I would say, the technology, the transparency, and also the level of engagement that we as an investor are having with the underlying issuers that we're ultimately investing in. And this is, I think, one of the key developments and important developments that we and I think many other emerging market debt managers are continuing to progress, specifically related to the ESG topic.
And looking to the year ahead, there's increasing speculation about the direction of inflation and of rates. What's your view on that, and how are you positioning the portfolio?
So I think the thrust of that question you're asking is how resilient is emerging markets today against that backdrop where liquidity provision is getting removed and there's upward pressure on US rates. Of course, you don't have to look too far back in the past to sort of see certain instances where in an environment where the Treasury curve is repriced higher, it's created a significant amount of angst across emerging markets. 2013, of course, the taper tantrum event was really the last episode that people tend to focus on. And I think it's important just to highlight here that there are very large differences, particularly regarding the level of fragilities in aggregate across emerging markets today compared to what existed back in 2013. In 2013, it was occurring against a backdrop where I would say that the technical buildup of interest in emerging market debt had been considerable. So there'd been significant inflows from an investor perspective into the asset class. And if you look at metrics such as foreign holdings in the domestic bond markets across EM at that particular point in time, they were very, very high. And it was also against a backdrop where the level of external imbalances was also considerable. So the aggregate current account position for emerging market debt in 2013 was essentially running a very large deficit. Almost the complete opposite is true today. Indeed, if you look across the aggregate current account positions for emerging markets today, they're actually in the strongest position they've been at for more than 15 years. And so the potential vulnerabilities to the asset class associated with essentially the repricing in global liquidity is less important today, simply because of the fact that their requirement for that global liquidity is much less.